You got paid on Friday. By Sunday night, you have already mentally divided that money into categories that do not exist anywhere except inside your own head. The rent money is untouchable. The grocery money is separate. The fun money, whatever is left after you have done your mental math, that is the part that feels available. That is the part you spend. And here is where it gets interesting. You would never touch the rent money to buy something you do not need. That would feel wrong, irresponsible. But if you happen to find a $20 bill in the pocket of a jacket you have not worn since last winter, you spend it on something completely unnecessary without a second thought, because that money appeared outside of your mental budget. It came from nowhere, so it goes back to nowhere. Your brain does not process all money the same way. It sorts money into invisible mental buckets: income, windfalls, savings, bonuses, tax refunds, and it applies different rules to each bucket. Money in the fun bucket gets spent freely. Money in the rent bucket gets protected fiercely. The problem is that these buckets are not real. $1 in your rent fund and $1 in your entertainment fund are the same dollar. They buy the same things. They grow at the same rate. They pay down the same debt. Your brain knows this on some level, but it does not care. This quirk of human psychology has a name. It is called mental accounting, and it is quietly keeping millions of people financially stuck. Not because they do not earn enough, not because they are irresponsible, but because their brain is running a financial operating system that was never designed to build wealth. It was designed to feel in control. And those two things are not the same. My name is Arthur. This channel is about understanding how money actually works, not how we wish it worked, not how it is supposed to work, but how it actually behaves when it collides with a human brain. If that sounds useful, subscribe. New video every week. Here is what mental accounting is, where it comes from, and exactly how it is costing you money right now with numbers. Mental accounting was first described by the economist Richard Thaler in the 1980s. Thaler, who would later win the Nobel Prize in economics for his work on behavioral economics, noticed something that classical economics had completely ignored. People do not treat money as perfectly fungible. Fungible is the economic term for interchangeable, meaning $1 is identical to every other dollar, regardless of where it came from or where you put it. Classical economics assumed this was how humans behaved. Thaler noticed that it was not even close to how humans actually behaved. In one of his early studies, Thaler described this scenario. Imagine you bought a ticket to a play for $50. When you arrive at the theater, you realize you have lost the ticket. Would you buy another one? Most people said no. It felt like they would be paying $100 for a single play. Now imagine a different version. You are on your way to the theater to buy a ticket for $50. When you arrive, you realize you have lost a $50 bill from your wallet. Would you still buy the ticket? Most people said yes. It is just $50. You lost different money, not theater money. But here is the thing. In both scenarios, you are in the exact same financial position. You have lost $50 and you need another $50 to see the play. The math is identical. The outcome is identical. But the decision feels completely different because your brain has mentally assigned the first $50 to the specific category of this play, and losing it felt like paying double for that one thing. This is mental accounting in its purest form. Your brain creates invisible ledgers, assigns money to specific categories, and treats those categories as if they have different rules. And once you understand this, you start seeing it everywhere in your financial life. Let us talk about where mental accounting actually costs you money, because it is not abstract. It is specific, it is measurable, and the amounts involved are significant. The first place mental accounting costs you money is the tax refund trap. The average federal tax refund in the United States is approximately $2,800. According to surveys by the National Retail Federation and various behavioral economists, most people spend a significant portion of their tax refund on discretionary items, things they would not have bought from their regular paycheck: vacations, electronics, clothes, things they wanted but kept telling themselves they could not afford. Why? Because the refund feels like found money. It did not come from your regular paycheck. It came from the government in a lump sum at an unexpected time of year. Your brain puts it in the windfall bucket, and the windfall bucket has looser rules. Here is the math on that. If you receive a $2,800 tax refund every year for 30 years, and you spend the entire thing each time, you have spent $84,000. If instead you invested that $2,800 each year into an index fund, earning a 7% average annual return, after 30 years, you would have approximately $280,000. The mental accounting error, treating refund money as fundamentally different from paycheck money, costs you approximately $200,000 over a working lifetime. Not because you made bad investments, because you decided this particular pile of money was available to spend. The second place mental accounting costs you money is the bonus and commission trap. This one hits hardest for people in sales, consulting, or any field where a portion of income is variable. Most people mentally separate their base salary from their bonus or commission income. The base salary is serious money. It pays the bills. It goes to the budget. It is treated with care. The bonus is different. The bonus feels earned in a different way, arrived in a different way, and the brain grants it different status. It goes in the windfall or extra bucket, and money in that bucket gets spent at a rate that money in the regular bucket does not. Here is what this costs. Imagine someone earning a $60,000 base salary and an average bonus of $12,000 per year. If they budget and invest their base salary carefully, but treat the bonus as extra spending money, they are losing $12,000 a year to a mental categorization error. At a 7% return, that $12,000 per year invested over 20 years grows to approximately $490,000. Spent each year on things that felt like a reward for a bonus, it grows to zero. The money was real either way. The treatment was not. The third place mental accounting costs you money is the credit card versus cash illusion. When you pay for something in cash, there is a psychological pain response. Researchers call it the pain of paying. You physically hand money over. You watch it leave. Your brain registers a small loss. When you pay with a credit card, that pain response is significantly muted. The money leaving does not feel immediate. It feels abstract and future. So people consistently spend more when using credit cards compared to cash. Studies have documented this effect across categories from fast food to luxury goods. In one famous study, MBA students bidding in an auction paid significantly more for the same item when told they would pay by credit card versus cash. Now add mental accounting to this. When your credit card statement arrives at the end of the month, you see the total balance. But by that point, you have mentally moved on. The dinner, the Amazon order, the impulse purchase, those are in the past. They are mentally settled. The credit card payment is in the present. Your brain has a hard time connecting the current pain of payment to the past pleasure of purchase. So the lesson does not stick and the pattern repeats. If that behavior causes you to spend even $200 extra per month, which research suggests is a conservative estimate for the credit card effect, that is $2,400 per year. Over 20 years, at a 7% return, that is just under $100,000. Lost not to a single bad decision, but to the consistent, invisible gap between what your brain thinks you spent and what you actually spent. The fourth place mental accounting costs you is the savings bucket illusion. This one is subtle and almost universally present. Most people have multiple savings accounts or mental categories: emergency fund, vacation fund, car fund, Christmas fund, holiday fund, and they feel good about having these categories. It feels organized and responsible. The problem is that these categories can work against you. Here is the scenario. You have $800 in your vacation fund. You also have $1,400 in credit card debt at 22% interest. You would never take money from your vacation fund to pay off the credit card. That would feel like you are giving up the vacation. So the credit card sits there, accruing interest. The interest on $1,400 at 22% is approximately $258 per year. The vacation fund earns almost nothing in a typical savings account, maybe $10 to $20 per year on $800. You are paying $258 to protect $800 that is sitting still. The financially rational move is obvious. Use the vacation fund to pay down the credit card and then rebuild the vacation fund from scratch. But mental accounting prevents this. The money in the vacation bucket is vacation money. It cannot be used for anything else, even if using it for something else would make you significantly better off. Across America, people are holding cash in low-yield savings accounts while simultaneously carrying high-interest debt. This is not irrational behavior. It is a perfectly predictable outcome of mental accounting, and it costs real money. The difference between the average credit card interest rate of around 20% and the average savings account rate of around 1% is a gap that, applied to thousands of dollars held in these mental buckets, costs households hundreds to thousands of dollars per year. The fifth place mental accounting costs you is how it distorts your perception of relative prices. Mental accounting interacts with what economists call relative pricing, the tendency to evaluate cost relative to the thing being bought rather than in absolute terms. Here is the classic example. You are buying a jacket that costs $125. The salesperson mentions that the same jacket is on sale at another store across town for $75. Most people would make the trip to save $50. Now you are buying a new car that costs $31,500. The salesperson mentions that you could get the same car for $31,450 at a dealer across town. Most people would not make the trip to save $50. The $50 is identical. It buys exactly the same things. But the jacket brain says $50 is 40% of the purchase. Meaningful. The car brain says $50 is less than a fraction of a percent, not worth the trip. This is mental accounting applied to value judgment, and car dealerships, furniture stores, and appliance retailers exploit it systematically. They make you negotiate from a large number, where individual savings feel proportionally tiny, rather than from zero, where every dollar would feel significant. The result is that people routinely leave hundreds of dollars on the table during large purchases that they would never tolerate losing during small ones. If you make one large purchase per year, car, appliance, furniture, renovation, and leave an average of $300 on the table because of relative price distortion, that is $300 a year. Over a working life, at 7%, that is approximately $31,000, lost to the brain's insistence on judging value relatively rather than absolutely. So what do you actually do about this? Because knowing about mental accounting does not automatically fix it. You cannot simply decide to perceive money differently. The brain's systems are not fully under your conscious control, but you can design systems that work around those systems. The first fix is to treat all money as one pool and automate the allocation before your brain categorizes it. The reason mental accounting is so powerful is that it happens automatically at the moment money arrives. The fix is to move money before that categorization happens. When your paycheck arrives, automate a transfer to your investment account and your high-interest debt payment before you see the money, not after you have budgeted before. When the tax refund arrives, set up a recurring investment contribution the same day. Move the money before the vacation bucket can capture it. The money does not feel different if it is never available to feel different about. The second fix is to consolidate your debt picture before you budget your savings. Before you decide how much to put in any savings category, look at all of your debt rates. If you are carrying any debt above 5% interest, and most credit card debt is above 18%, that debt should be addressed before any savings goal that earns less than its interest rate. The mental accounting that keeps your vacation fund and your credit card debt in separate mental silos is costing you the difference between the interest rate you pay and the return you earn. Close that gap before you fund the next bucket. The third fix is to convert large purchases into hourly wages. Before any purchase over $100, do a single calculation. Take your after-tax hourly rate, your annual take-home pay, divided by 2,000 hours, and divide the purchase price by that number. If you take home $50,000 per year, your hourly rate is about $25. A $300 purchase costs you 12 hours of your working life. That is almost 2 full days. This reframe forces your brain out of relative price thinking and into absolute thinking. Not every purchase will fail this test, but many impulse purchases will, and the ones that do will feel different. The fourth fix is to run your finances in writing, not in your head. Mental accounting is a product of in-head accounting. When you track money in your mind, you naturally sort it into mental categories with different rules. When you track money in writing, in a spreadsheet, an app, or even a notebook, all money appears as the same thing, numbers, and numbers follow consistent rules. A dollar in column A is the same as a dollar in column B. The simple act of externalizing your finances onto paper or a screen disrupts the mental categorization process. You do not need a complicated budget. You need a single document that shows total income, total debt, total invested, and total monthly spend. One page, one picture, one consistent set of rules. That document is more valuable than any budgeting app, any financial hack, or any clever system because it removes the mental silos and replaces them with reality. Here is the core of everything that was covered. Your brain is not broken. It built mental accounting categories as a way to manage complexity and feel in control of limited resources. In a simpler world, with smaller stakes, mental accounting is a reasonable shortcut. In a world where the difference between right and wrong financial behavior compounds over decades, it is a leak you cannot afford. The windfall that goes to vacation because it came from the government. The bonus that gets spent because it felt like extra. The vacation fund that earns 1% while the credit card charges 22. The $300 left on the table because a negotiation started from a big number. These are not dramatic financial catastrophes. They are small, consistent, invisible errors that compound the same way good decisions do, just in the wrong direction. The brain will always try to sort your money into buckets with different rules. Your job is to design a system that catches that instinct before it costs you. Automate the allocation. Consolidate the debt picture. Convert purchases into time. Run your finances on paper. $1 is $1. It will always be $1. The only variable is what you decide to do with it before your brain decides for you.